Now, when we're looking at bond yields here, this is a very, very important slide. This one and the next one, because this one puts things in words and the next one's going to put it graphically for you as we go through. So while fixed coupon bonds pay a fixed rate of interest, the bond yields will fluctuate. So, right, you can see it's going to continually pay that $60 a year, as I've demonstrated, or that payment of $3 or $30 every 6 months. But when bond yields change or interest rate changes, when interest rates fluctuate, the value of the bond is going to fluctuate. And you need to know this, commit this to memory. It's really not hard. It's an inverse relationship. So when yields go up, bond prices fall. And vice versa. When the yields go down, interest rates go down, the prices go up. Okay, so you want to remember that for your exam. Extremely, extremely important. That's going to get a giant star, because you'd want to remember that as well. Now you might say, well, great, why does the price fall? Well, if you had a 6% bond, and now you could turn around and get 7% out in the marketplace because interest rates have gone up, who's going to buy that 6% bond? No one, but they know they can get a 7% rate, right? Maybe they can get a yield to maturity of 7%. In your bond, they're only going to get 6%. So your bond has to fall in price. Okay. Here are some of the other examples, the foundational knowledge, as I call it. Some of the other relationships you need to know, where the coupon rate is greater than the YTM, then the price of that bond is greater than par. It's at a premium. The coupon rate equals our YTM, then the price is going to be here at par. And lastly, if our coupon is below our YTM, then our price is lower than par, and it's going to trade at a discount. Now, obviously, all this is in our Schweser notes available for you as well, but this is really the big one, because this will carry over from levels 1, 2, and 3. Now, I like pictures. So not only do I like to teach in words, but I also like examples. I also like pictures, and you could even, draw simple pictures for yourself while you're going through your studies. And this is really the relationship between bond values and market yields. So what we're going to say here, and I'm going to use 1,000 as our par value, because that's, like I say, one of our common denominations there. And we're going to have an 8%, say, annual coupon bond. So we're going to say we're right there at this dot right here. But what happens if interest rates fall? So we're going to be heading in the wrong direction here for our interest rates, but look what's happening to our bond value, because now, boy, you only can get 6% out in the marketplace, but you own an 8% bond. That's a little more valuable, right? That makes sense. I'm just going to make up numbers. I'm not sure if this would work out on your calculator, but let's assume that the bond value goes up to 1,025. So you now are trading at a premium. But what happens if interest rates go up? What happens if now we're at a 10% interest rate, right? Well, no one's going to want to buy your 8% bond, so you've got to lower the price on that bond in order to sell it, which means you're going to sell it at a discount. So you're going down this way. Now, just an observation, and this is a little bit beyond what we need to be concerned with in today's discussion, is you can see this is not a linear relationship. I'm going to give you a little preview anyway of some of the other things you're going to see. So it's not a linear relationship. See, it's more of a convex kind of curve here. And that's because changes in rates doesn't always equal the estimated change in the value. And you're going to learn a couple of other metrics as you go through studies, duration and convexity. So that's one of the reasons why it's not going to be a linear relationship.